Good evening, everyone, and welcome to this webinar. My name is Sara Waqar, and I have over 12 years of experience in the financial markets as a prop trader and as an educator. And my expertise lies in derivatives trading, specifically in currencies, commodities, and stock indices. I'm licensed from FINRA in the USA and from ESCA UAE as a wealth manager and an investment advisor. And I have been teaching people since the past 10 years from all sorts of backgrounds and fields on how to trade effectively and with consistency and how to execute risk management and build trading discipline. Welcome to Amana. We are a brokerage with 15 years of track record and we have over 100,000 traders worldwide. We offer the best trading platform executions and overall trading experience. We have multiple regulations, both local and international, including ESCA and DFSA from UAE. And worldwide, we have SISEC from Europe, CMA from Lebanon, LFSA from Malaysia, and we also have FSC from Mauritius. So we have a focus on the MENA region, and we provide different kinds of instruments across multiple asset classes for you to trade. That includes regional stocks, international stocks, commodities, currencies, indices, ETFs. So before I begin, I just want to tell you if you have any questions, drop them in the Q&A section below. So there is the chat and there is the Q&A. So please don't write in the chat. Just drop them in the Q&A and I will try my best to answer them as I proceed. If you want any further clarifications or you want to get in touch with us, you can email us at support@amana.app, or you can go to the website directly and chat with our live support, or you can even call us directly. So, for those of you who've attended the previous webinar, it was an introduction to indices. And what we are going to do today is we're going to build on the previous discussion and we will go into more depth. We will primarily focus on the correlations between these major indices, how they reacted during major financial crises like the COVID-19 and the global financial crisis, how their volatility has changed over time. And then we will be discussing the most practical and effective strategies that you can use to trade. So I will very quickly give a recap for anybody who did not attend the previous webinar. As we know, an index is essentially a basket of different stocks, such as the S&P 500, which contains the US economy's top 500 stocks by market capitalization. So it is kind of like a reflection of the best 500 companies. An index is essentially a reflection of the entire economy, of investor confidence, of corporate growth, capital flows, market psychology, even government efficiency, all combined into one instrument. So institutions, professional traders, and hedge funds are all very interested to know how the indices are doing, because they are actually watching the pulse of the economy through that one number. Indices will insulate you against company-specific risks. This is what we talked about earlier as well. Because you have not invested in a single company, you are insulated against, something like major changes in the share prices. So you are actually, you definitely have market or risk, because the macroeconomics are going to affect the index. However, if it's a company-specific issue, then the index might not be affected that much, because it is a diversified basket of so many other companies. So this is one reason why people like to invest in indices, because of the diversification. Looking at the S&P 500, we know it covers 80% of the US equity market capitalization, and the value behind it is about $15 trillion. Also, it's reconstituted quarterly, meaning that if there is any company, all the companies are reevaluated in terms of their value and market capitalization, and the index is then re-weighted according to the new figures, and that gives a very accurate snapshot of the economy. So it is a constantly evolving index, it's not stagnant. Because of this weightage or market cap weighting, about seven companies, which are the Magnificent Seven, they form 33% of this index. The more larger the company, the more influence it's going to have in the index. So these companies, as we know, Apple, Microsoft, Nvidia, Amazon, Meta, and Alphabet, and Tesla, these are those seven companies which form 33% of this huge market, and the remaining 493 companies fall out of this. They are in the remaining 67%. So looking at the performance of this index, so this is again a very interesting topic. And I was looking at the figures and I found out something new which actually I had not known before. And that was that I actually knew that the S&P was giving an average annualized returns of about 10% over the past 20 to 30 years. But what I did not know that was actually giving these returns not only over the past 20 years, but over the past 150 years. So yes, you've heard that right. It has been giving that return, that average return for more than a century. And that is something extremely valuable as an insight. If you're a trader, it's something extremely valuable to understand as we look into this index and as we look into other indices which represent the US economy. So another very interesting fact about the S&P is that it's been in a bull market. When it goes in a bull market, the average bull market actually lasts for 5 years. So again, that's something very interesting, that the average bull market is 5 years, the average bear market is 9 to 14 years. And again, despite all kinds of crashes, the index has always recovered and it has always reached new time highs. We discussed what was the reason. One of the reasons was the technological advancement, which will always be embedded in this index, no matter what is the theme of that decade. That theme and all the earnings and profits related to it will automatically reflect in the S&P. As it used to be in the 1980s, it was the computer, then it was the internet. So the companies which earned the most formed the greater part of the index. Maybe if you go back in the 1920s, it was the mining companies or the electric companies. Now what is the scenario? We have Nvidia, which is the number one company in the index. It actually represents 7% of S&P. And that is basically the company that is providing the AI chips to, all the other major AI companies like, OpenAI and all of these. So since AI is what is actually driving this rally, these top seven companies are based on this AI and tech. So again, unlike any traditional investment that you would do, which is offering a fixed rate of return, the S&P 500 still is offering a much better return to you, because what you are actually, by investing in this index, you are owning some of the world's largest and most profitable companies. So over time, these companies are bound to grow in revenues, in earnings, in innovation, in market value, which is going to drive their stock prices higher. So another interesting fact about this index is that 80% of the times it's in a bull market. And what is the key implication of that is, I would frankly say avoid shorting it, because the gains are definitely more than the losses. The upward momentum is definitely more than the downward momentum. So yes, I understand there are also, intraday traders, and you might get a very clear setup for shorting the index. For example, the way that it has peaked right now, as you can see in front of you, some kind of consolidation which involves strong bearish price action might not be, a completely invalid setup to short the index. But what I am trying to say is that being on the long side is going to give you much more gains than being on the short term. And that is true both for the short term, for the medium term, and for the long term. So there are three ways that you can trade the index. One is through the ETFs, which are non-leveraged, and that's the closest to buying the physical shares which represent the index. So an ETF is like it's a fund whose shares are traded on the stock exchange, and you can buy the shares, and the fund is exactly buying the underlying stocks of S&P 500. The other ways are that you can trade future contracts, which we have here on the platform. So the future contract is based on a certain forward or future price of this index, and the good thing with it is the flexibility. You get the leverage, you can amplify your profits. But yes, if you don't do your risk management, your losses can also be amplified in the same manner. You can trade on margin, you can do position sizing more accurately. If you don't want to trade the futures because of the futures have an expiry date, you can also trade the spot index, which we have here, but which is good if you're doing intraday trades. But if you hold it overnight with the spot index, you will have to pay a financing fee. So apart from S&P, the other indices that we have, which are based on the American market, are the Dow Jones. I think everybody has heard of Dow Jones, and the Nasdaq 100. FTSE is the UK top 100 companies. So that is not the American index, but I've just put it here for a comparison. So how are the S&P and the Dow Jones related? Today, we are not just going to see the indices, but trying to understand what's the relationship between them. Dow Jones represents the top 30 elite US companies, and it's kind of the weightage is not just in tech, but it's across other sectors, other traditional sectors as well. So if we go to Nasdaq 100, that is an index of 100 largest non-financial or tech companies. So tech companies actually form about 58 to 60% of Nasdaq 100. So in terms of the tech weightage, Nasdaq has the highest weight, and S&P has about 28% of the tech companies. After that, it's got, I think it's 13% is healthcare, and about another 13% is the financial and the banking industry for S&P. So what's the relationship? The relationship is that the Nasdaq and S&P are very highly correlated. So they're 90% of the times correlated, and they're not 100% correlated. So obviously there is some divergence. And out of all of these indices, it is Nasdaq which is leading, and that is mainly because it has a higher representation of tech companies, and those companies are very sensitive and responsive to policy changes and to investments. So right now, what is happening is that the Nasdaq, if there is any movement, Nasdaq is more volatile and it is leading the move, and then S&P is following. Actually, these days the market is it's in a super rally. But even then, if you observe closely, you will know that by percentage, Nasdaq is moving more, and it's more volatile and it's more quick to move. So if we go to Dow Jones, and I think I should actually go and show you. So here is Nasdaq 100. So actually, there are two types of indices based on Nasdaq. There is Nasdaq Composite and Nasdaq 100. So whenever I say Nasdaq, I'm talking about Nasdaq 100. Don't confuse it with Nasdaq Composite. Nasdaq Composite is an index which contains all of the companies which are on the Nasdaq exchange, which is like 3,000 companies. And this is Nasdaq 100, which is the index with the highest tech weightage. So usually this index is more interesting because I'm saying because of the way that it moves, and the interesting thing is that it has actually the returns. If you see it, it has actually given phenomenal returns. So it has given the performance has been 35% in the last 12 months alone, and this is without any leverage. This is the nominal performance of this index, which is huge. S&P has performed really well too. That's about, I think, 25%. And Dow is definitely slower because of the way that because of how it is composed. So this is Dow here, and yeah. So as you can see, the difference here in the one thing to please understand is you have to be. I'm observing all these price data on the daily time frame, which is giving me a bigger picture, macroeconomic picture of at least 4 to 6 months. So Dow has not yet peaked. This was the previous peak, and it's not at its ever high, right? So we got a previous peak at 50,608. So we haven't reached that. But if I look at Nasdaq, you can see that it is, you can see the difference in the pace, and you now understand why that is so. Also, like the cycle that we're having now is very tech specific. So that is why Nasdaq has become very, very sensitive. It's going to fall more quickly, it's going to rise more quickly. And yeah. So if I also look at FTSE is the UK index, and that is actually a much slower index. And there are a couple of reasons, like it's got to do with the UK economy. That index is, is more weighted towards mining and finance and banking and energy. So it has less of tech stocks in it, which is one of the reasons why it's slow. Let's find FTSE and let me show you what have been the returns in the past 12 months. So you can go here on search, and here on top, if you click indices, you will get all the list of indices. So I did add it to my watch list, but it seems like I can't find it. So we have FTSE 100 here, which is, I will add this, and let's take a look at the performance and the trend, the price action. So as you can see, again, this is quite different from S&P and Nasdaq. Again, it has not reached its previous peak was here. It was in 20 or 27th February, and there's quite a bit of lag. So the correlation between S&P and FTSE is usually 60 to 80%. And there are periods or regimes in which this correlation declines, goes closer to 60, or it will move more closer to 80, depending on the economy, on like the pound dollar as well. So we have to keep in mind the currency, like the effect that the currency is having on the index. So obviously, if the pound is depreciating, then the returns become less in terms of dollars. Yeah, so FTSE is heavy in energy, mining, and financial, sensitive to commodities, and because there's a higher energy in mining, there's a higher commodity weightage in FTSE. So whenever the commodities are doing well, FTSE will do better, and if they are not, they're stagnant, then FTSE will not do that well. If we look at other indices, we have the DAX, which is the top 40 German companies. We have the Hang Seng, which is the top 50 Hong Kong companies, which gives some exposure to the Chinese economy. We have Nikkei, which is the Japanese index, which has been doing really well in the past 3 years. And this year it has actually topped all gains. It gave 65%, due to a number of reasons. So its historical performance is obviously not that consistent like the American indices, but for the past 3 years, it has gone up by, the returns have gone up by 4 to 5 times. And there are certain reasons for that. The biggest reason is, the depreciation in the yen has actually caused a boost in the exports, because they have internationally they have become more competitive. Even though the yen has depreciated, the exports have become competitive because of that depreciation. Also because of certain policy changes, because of finally they're experiencing some inflation after decades of stagnation, and the economy is growing. And yeah, there are a lot of companies which have become the leaders of semiconductors, and that is driving the growth in this index. So moving on, let's discuss the correlations, and then we will move on to see how these indices perform during crisis. After that, we will look at the volatilities and how that has changed, and what kind of trading strategies we can use to trade them. Okay. If we go and we Sorry, we see S&P again has the highest correlation with the Nasdaq followed by Dow. Dow is actually closer to 85 to 90%. And then FTSE would be around 60 to 80%. So if you can observe any bigger or more meaningful divergences between these indices, then yes, those divergences can be traded. So one way of looking at it is this way that right now we know that Nasdaq is leading. So in normal market conditions, these divergences can be observed easily, as I showed you on the charts. Like FTSE has not peaked in the same manner. So what we can do is that, if we know that Nasdaq shows a high, like creates a high or a peak first, we would know that maybe S&P is going to follow it shortly after. So the S&P is going to act as a middle confirmation index. So Nasdaq moves first, then S&P moves, and then the Dow moves. Okay. And this, you can use this to your advantage when you are trading or making, or timing yourself. The Dow, as we know, is quite slow because it contains the older defensive kind of stocks and financial companies and less of tech. So, but the Dow does eventually confirm S&P, which can actually make for an interesting strategy as well, because the Dow has not yet peaked, right? So I'm not actually suggesting you a trade, but I'm asking you to observe how well these divergences play out on the charts and how they actually play out in the long term. So you can use these kind of divergences when you are trading to your advantage. So, and one more thing that I would like to point out is that these divergences happen when the market is, it is calm and clear and trending and in a rally. If there is a market crash, if there is a panic, if there is extreme speculation, right, then and there are strong downward moves or a strong due to some panic, then this correlations actually break down. And you would actually see all of these indices just plummeting. So if you have a strategy where you think you are diversifying by putting in these indices, then you have to think again, because these indices do move together in times of crisis. They will actually all, there's no correlation. They means there's actually a perfect correlation. So they will move together on the downside. And if you want to really diversify, then you should consider also moving into other alternative assets like gold, or commodities like oil or any other kind of asset class. So again, just trading them all in the same direction is going to not actually give you greater risk exposure rather than diversify. Okay. Someone has asked me, what does gold and silver look in the long run? So I am going to definitely answer your question, but you will have to wait a bit. So I will answer it towards the end. Okay. Now, let's take a quick look at how these indices performed. I have discussed this. So this is again, this graph is showing the divergence between S&P FTSE, which can be a considerable divergence. And yes, you can trade that. So obviously you will not blindly trade the divergence. You will be looking at the trend as well as support resistance levels, appearance of confirming price action signals, and definitely doing your risk management. But this is just like a trading idea that you can benefit from. We've talked about this. Stress events will all cause the markets to not have that correlation, but actually move completely in the same manner downwards. So again, that means that you have to understand that your risks are not diversified and you need to diversify your risks in other ways. Looking at how these markets performed in crisis, so we had three major events which caused global collapse, or it seemed as if everything was collapsing. The first was the dot-com bubble, the second was the global financial crisis, and the third was the COVID, right? And these caused the major downward swings in these indices. So the first, as we know, was the dot-com bubble, which was valuation driven. So it was a valuation driven crash, and the S&P at that time actually went down by actually halved. So it went down by 50% and took 7 years to recover. The Nasdaq was down by more because, again, of its sensitivity and because it is more volatile. And it took it 15 years to recover. Dow Jones, because of the fact of the way that it is composed, um, it was more resilient and it just went down by 38%. But more than the dot-com bubble, I tend to look at what I actually tend to look at more when it comes to checking the resilience of these indices is the last major event, which was the COVID. So I place the most importance on that to understand that if something similar happens in the future, something which is, as shocking or, just as threatening, how are the markets going to react or how are the indices going to react? So in 2007 to 2009, we had S&P dropping by again by 57%. Now Nasdaq just dropped by 55, and more or less all of these indices dropped by approximately half of their value, and it took them 4 years to recover because we had very strong policy interventions like the zero interest rate policy and the quantitative easing. So the recovery was helped, and that liquidity crunch and that housing collapse which occurred, it was definitely helped by that extreme uh, policy intervention measures, which did resolve this crisis eventually in 4 years' time. Okay. But if we look at the COVID, in COVID, what happened was it's very interesting. The S&P fell by 34%, but the time that it took to fell was the shortest. So this actually shows an extreme amount of volatility has actually entered the markets, and I will also discuss what is the reason for that. So in my opinion, if something of this sort had happened maybe 10 years ago, the S&P or any other major index or benchmark, financial benchmark, would have actually taken more time to collapse to that level. And it would have definitely taken more time to recover. But in COVID, what happened was we saw a 34% decline in only 33 days and a full recovery in 5 months. So that essentially was more like a major correction rather than a crash and I will discuss, the reasons why this was such a quick recovery. FTSE was 35% down, but then it had a very severely lagging recovery due to the absence of high growth tech companies, because high growth tech companies are not part of the FTSE. And we know that the major investments and interest is all in AI and high tech right now, and that is what is driving the markets. So whatever will have more tech weightage is going to give more returns, is going to be more volatile, is going to be affected more, whether it is in terms of gains or in terms of losses. So this was the fastest crash in history, which produced the fastest recovery due to the immediate policy response and forced technological adoption. So there was an extreme amount of quantitative easing and bailing out by the US government during this, which then later led to higher inflation levels and other effects as well. But doing that actually meant that the market recovered faster. So this is a summary, again, of what we have discussed. That this is actually a comparison of how these indices have behaved during crisis. And again, the causes were different every time. The dot-com was a valuation or a speculation issue. The global financial crisis was a liquidity issue, a liquidity crunch. And the COVID was actually a completely different thing. It was an exogenous shock. So modern markets are actually becoming more faster, more sharper, and that actually also requires, even much more risk management on our part and on the part of, policymakers and institutions. They have to understand that a move which occurred, which could take 5 years to sorry not yeah, let's say some move which could take 5 months to happen can now happen in 5 days. Some move which could take 5 years to happen can now actually happen in 5 months. So we have to make our decisions based on the kind of volatility that we see now. So if I look at the volatility, there's a way to measure it. It's through the VIX, which is actually a volatility index. So it's also known as the fear index, and it is based on the 30-day volatility of the S&P 500 derived from options. It's called the fear index because it measures uncertainty in the markets. So you can actually observe the values. So we have VIX over here. So you can see that right now it is standing at 20. And how do we interpret this? So historically, values from 10 to 20 are considered to be normal, that the market is normal, or it could be slightly, trending in a certain direction, but there is no fear, there is no panic, and the volatility is low. And when has the volatility gone higher? Obviously, in times of crisis. So if we look at the dot-com peak, the value of VIX was 43. In the global financial crisis was 80, and during COVID, it was actually the highest. It was the all-time high. It was 85. So if we want to check the panic or the fear in the market, this is a good way. This is a good measure. You can go and observe this index, VIX. And now let's see why is it that volatility has increased so much over time. So first of all, I think that it is a lot to do with the way that we trade. It's a lot to do with the technological advancement and the way that trading has been digitalized and the amount of access that we have. Also, it's got to do a lot with the way information now travels. So information now travels within seconds, which means that that is amplifying any good news or any bad news. And that was not the case 20 years ago. Also, we see that the Fed, which is the American Central Bank, it has become very responsive in terms of policy interventions. So, low rates and quantitative easing is going to suppress volatility, but if there is rate uncertainty or if there is, you know, e- like tightening monetary cycles, that's going to increase the volatility. And again, geopolitical events like wars and pandemics and political instability will increase this volatility, which we have seen in the past as well. Apart from that, like I said, you have lots of things now like algorithmic trading. You have HFT, which was not there even 10 years ago. Now we have AI, which is driving all these algorithms and which is making everything even faster. We have things like 0-day options. So these are options which expire in a day, and intraday traders use them to bet on the market. Again, they increase the volatility. We've got a more increased passive investing flows. What that means is we have ETFs, and based on let's say indices like S&P, and when demand for the index and the ETF goes up, it automatically buys the underlying stock. So that is kind of a non-discretionary investment which keeps flowing into the ETFs, which has increased so much in the past few years. So again, what we need to remember is volatility has increased by a factor which was unimaginable. And many times I observe the forecasts given by big investment banks like JP Morgan and Goldman Sachs. And I just feel that they are very conservative because, for example, this year's forecast for silver was, I think that was by JP Morgan. I'm not sure, either of them. It was $80 to $81. But what I see is so much volatility that, and because of the crisis situation, definitely there is the safe haven demand for gold and silver. So looking at the macroeconomics and looking at the broader picture, definitely I feel the metals are bullish and should go up. So again, we have to keep in mind that what the moves that we used to see even 5, 4, or 3 years ago, we are seeing much bigger, greater moves than that. Any panic can literally, gets amplified. Any recovery also gets amplified by many times, and these are some of the reasons that I just explained. Now, as traders, what should we do and how to do? How do we trade these indices? How do we make money ourselves, right? That's the biggest question. So there can be a few things that we can do. One is the structural trend following. If you don't like, if you're not a trader, you're an investor, then you can actually invest in an ETF, which is Nasdaq based or S&P based, because these are giving right now, obviously, these are giving the highest returns. Nasdaq actually is even higher. If I show you this, this is a table which is showing us the returns the indices gave over the last 10 years, the annual returns over the last 10 years. And Nasdaq, if you see, Nasdaq 100 has been giving 18%, which is very high, in my opinion. It's a very good return. And even I checked for the last 20 years to be more consistent. And for 20 years, it's around 16%. S&P has been given the last 10 years 13.6. So again, these are very good numbers. So if you want to invest, long-term investors can invest in an ETF. And if you're a trader like me and you're trading on the higher time frames, then it's obviously a very good idea to buy the dips. So what can we do here for Nasdaq? We definitely know this is an upward rally. We look for some kind of retracement or some kind of consolidation. So we have a very strong rally right now. So potential entry points here could be when the market is consolidating. What happens in super rallies at times is that dip does not come quickly. And if you want to in a position quickly, you have to actually observe the price action very closely. So, for example, there's a consolidation here. As we see, price has stalled for 4 days, and this particular candle pattern is actually telling me that prices have consolidated and are preparing to break upwards, right? So this could be a potential entry for you here, putting your stop loss right below the setup, right? Yes, we can definitely trade in this manner. If you are more of a even longer term trader, you can go on the weekly and you can be, waiting for bigger dips like this one. So we could be waiting for a bigger dip for the market to correct to the previous level, or maybe to correct, let's say, maybe perhaps even less than that. But whenever it corrects and it's ready to go up, it would give you some sort of a signal. So the market can come down to here or maybe to here. But how do we know the dip is over? It's by observing the price action, which would tell us that now bulls are back in the market. So this kind of a strategy can work really well here. But again, please remember, if we are trading on leverage, it's completely essential to manage your risk meticulously and to have a stop loss in place. So again, we can buy on dips. Investors can invest. And by the way, we also have ETFs. Amana has, we also offer non-leverage trading. And if you want to know more about it, if you want to invest in it, you can again email us and we will get back to you regarding that. Again, the Nikkei is one example which is standing out. So even though historically it's given 11%, which is still quite good for the last 10 years, but as I showed earlier, this year it's actually superseded and outperformed anything in terms of the returns. So where is it? It was in my watch list. Can't find it. Here it is. So, okay. So if we scroll down, let's look at the charts. So again, it's a very strong rally. This is going till August 24. And like I always say, when you're looking at observing the trends and the price action or the support and resistances, you have to give more weight to the more recent data. So I will be giving more weight to the last 2 weeks or last month as compared to the last 3 months. And I'll give more weight to the last 3 months as compared to the last 6 months. So performance wise, it has out, yes. So the 1 year performance is last 12 months performance is almost 50%. It's 49.7%. And again, this is without any leverage. These are nominal returns. So this is actually quite amazing. So, is this going to continue or not? Frankly, right now, yes, if I cannot exactly say that, we're gonna get the same kind of returns in the future. That depends on many things, but there are certain conditions which are making the Japanese economy very, very favorable to invest in, and bigger institutional funds, investment banks, and even Warren Buffett himself have increased their exposure in the Japanese economy. So all of these conditions, the depreciating yen and all this, does make it look like this index will keep doing well in the future for now. Then we talk about the convergences. So I just talked about the fact, the leading and lagging behavior between S&P and other indices, and how we can actually, take advantage of that. So there is one other way that traders usually trading these indices, which is based on a simple moving average. So it's the 200 simple moving average, which is taken as an indication of the trend. So if I go here, or okay, here, and if I add the simple moving average to the daily chart, which is moving average. So it's the simple moving average, and sorry, we can adjust the parameter. So it should be the 200 day moving average. We go to settings and we put 200 here. I need to get rid of this. Wait, for some reason I can't get rid of this line. Let me try here, just to make the chart more clear. So this is the 200. Traders generally consider it to be an important long-term signal. And when you're observing this, please observe this on the higher time frame. Observe it on the daily or the weekly. Otherwise, it's not going to make a lot of sense. So even the prices are above this, it's usually taken it to be a bullish trend. And if they're below it, it's usually taken to be a bearish trend. So, and then there is what they call the golden cross ratio, which is the 50-day moving average crossing above the 200-day. So if we have to add the 50-day moving average to change this, this doesn't seem to work right now. Then I could have shown you guys the crossovers. Okay. Yeah. So the golden cross means the 50-day moving average crossing over the 200-day moving average, like this over here, is a bullish signal. And if the 50-day moving average is going below the 200-day, then that's a bearish signal. And again, it's applied always to the higher time frames, because if you apply to the lower time frames, it's not going to mean the same thing. But again, the moving average are just an indicator. So it's a lagging indicator, and you should not use it in isolation. You should combine it with other aspects of trading, like support and resistance and price action. So again, this slide is basically talking about the volatility, and that you have to just mainly keep an eye on the VIX. So when the VIX is below, that actually means, everything is fine, and the volatility levels, there's no fear or panic in the market. So in such a situation, it's the trend following which dominates, and you will not see a lot of volatility, but you might see stability. When the VIX is greater than 25, then definitely you should reduce the position size, because the volatility is higher, and you will definitely be placing higher stops, because you will be getting that kind of price action, wider candle ranges. So it means that you need to be more careful about your risk. Again, volatility is something that obviously can work in your favor if you are taking care of all the things, if you're managing your risk properly, if you are going in at the right level, at the right setup, in the right direction, then volatility can actually be in your favor. And then again, we can also talk about the event-driven trading. So we know that, certainly there are certain news announcements which do tend to impact the market, such as the FOMC, which is the interest rate decision, which comes after every 6 weeks, or the non-farm payrolls, which comes on Friday. So everybody has different ways of trading them. Some people will trade, trigger the trade right before the announcement. Some will do right to at that time when the announcement is being made. Others are going to wait for maybe even 2 hours or so for the dust to settle and for everything to normalize. And then they are going to understand how that particular announcement or how that particular release has impacted the market, and then they would trade. But how I trade is that basically I personally don't tend to trade into the news. What I do is I definitely observe the market and I will wait for that day to close. So since I'm a higher time frame trader, I'm not an intraday trader. If there is an FOMC on a certain day, I will definitely wait for the that session for that day to close. And the closing is actually what gives me the most important indication of what will happen tomorrow. So if it's a very strong closing, a positive closing, even though during the announcement prices seemed to go in the opposite direction. There are many times when during the announcement it's the other way, but when the market then completely reverses and closes in the other direction. So, as you know, I observe price action on the daily chart. So, for the daily candle to actually close, it's going to take the entire day. The New York market has to close for the daily candle to be completed, which means I have to just wait and see what the effect of that announcement was at the settlement of the day. And then accordingly, I will place a trade the next day. So this is what I do. So now I'm going back to your question, Dinesh, gold and silver outlook in the long run, right? So gold and silver, let's open the charts so we can take a look at what's happening. Okay. So I'd like to remove these indicators so I can have a clear observance. So it's a very interesting, this entire move is very interesting for me. It's kind of like a convergence to this level. So how to define more clarity is going to an even higher time frame. So let's go to the weekly, and here is your clarity in terms of gold. So I think everybody is clear now what is happening to gold, right? Overall, there's a definite macro uptrend as we see higher highs, and this movement was really supported by this very strong bullish price action signal and rejection of all these levels. Prices are now seen to consolidate at these levels. So the consolidation seems to be between which levels? The upper range is around 4,800 or 4,900, and the lower range is approximately. So these are approximate lines. Please remember, these are not exact lines. So between 4,500 to 4,800, there is kind of like a consolidation. What would be the best way to trade, in my opinion, because the overall direction of the market is upward. As a trader, would personally, because I am a trend follower, I would first of all avoid shorting it, and I would look for strong bullish signals at key levels on the higher time frames to have a bullish entry here. So this is what I do. Once I find my entry, I will put a stop loss, do my risk management, and enter the trade. So now let's go to the weekly, daily, and see if there is anything like that. Okay. On the daily, we have this very certain, this point, which is a very strong swing point here with strong downward rejections, right? And the price seems to be consolidating. So I obviously do not know for sure, but from what I can say from my experience is the price might tend to consolidate more. So this particular range might get tighter and tighter before it tends to move upward, break in direction of the trend. But again, we don't blindly get into the market. Let us suppose that, if I am to see another strong bullish signal, price action signal. So I've discussed price action signals in other webinars. At this particular level, that would be a good buy, right? Another buy could be because we still have this candle here. This is like another swing point which the market has created here. Another way we could go into this would be to place a stop below the swing. Sorry. So this is another swing point. So this is a level, need the horizontal line. Yeah. So there's a swing point created at this level, and right below the level, which is approximately 4,470, that could be, a good stop, or a more conservative stop could be right below this candle, which will definitely cause you to decrease your position size because the stop is widened. So your position size equals your risk on the trade divided by the stop loss size. If the stop loss size is bigger, it will automatically cause your position to be stronger if you have to be more conservative. And this is more of an aggressive stance. But again, if you do a risk management properly, obviously we have a certain direction, or we have a certain thesis about the market, and it can work and it might not work as well. So this is something we should always have to keep in mind, that no matter how confident you're feeling about a setup, what happens if it might not work? And that is the reason why we do the risk management and we place the stop losses. Silver would be definitely about the same. And again, silver has had a very strong bullish rally. So silver has been running out, and this would have been a good entry. We had a strong bullish price action signal right here. And one more very bullish signal for silver was breaking this point. So we had a swing point here, and then this swing point was broken by the recent rally. So again, upward, and the weekly will kind of, make things more clear. I always go to the weekly just to. So long-term trend, there's more bullishness here, but again, I would consider gold to have a smoother trend than this. So there's more choppiness here within the larger uptrend, and gold is definitely more clearer trend than this. But overall, I feel both of them are still overall bullish in the long term. Okay. Heather, you've asked if there is any way to have swap-free accounts. If you're trading spot, I think my colleague has answered you cannot have. But if you want swap-free, you can trade futures. So we have, for the same instruments, we have future contracts. For example, we have for the indices, we have this is the future contract for S&P, and this is the spot. So you can trade futures if you want to avoid the overnight charges. So okay, Heather, you want me to make support and resistance in silver on the daily time frame, right? Where is silver? So I would suggest this. So this is the previous swing level, which is more defined, but then I also see a swing level here. So this is definitely a good support. If you have to enter, it's a good stop loss placement. This would be probably too wide. So below this particular candle seems to be a good stop loss placement to me. If you have to go long, this is again not a very small, like it's still quite wide, but then it is also safe. The wider it is, the safer it is, but then again you have to compromise on your position size. One way to trade this would be, I could have a more tighter stop below this particular candle, but then again, that is a little bit more risky, and this is a little bit more conservative. So this particular point here, which you see, is also important. So this is not a key level, but a short-term level. So we had a swing point here. So let me put a line here. What would be best case scenario right now would be price retracing to this swing here. What was previously a resistance could now turn into a support. So this is around 80. And then we observe a strong bullish price action around 80-ish levels. If we find such action, then it could make a good entry. So this could be, let the market come down a bit, look for a strong bullish price action signal. You could put your stop loss right below that signal. Actually, someone has asked, how do you select the actual investment to invest in? Do you think the future is good for long-term or short-term investment? So what I do is I select the markets which I feel are the clearest and the best trending markets. This is what I do if I have to pick. There's so many different markets. And I go on the higher time frames, I look at the trends, and if I feel that I understand this market, I understand where it is moving and why it is moving and how it is moving. If the trend is clear to me, then I believe that is a good investment for me. This is personally how I see it. You can trade both in the short term and in the long term. That doesn't matter. You can have a short term horizon, you can have a long term horizon as well. Yeah. So I'm actually past my time, and thank you so much for coming to the webinar, and I will see you on Tuesday, where we will be discussing more about advanced price action. Thank you so much for attending.